Hey, welcome to our November monthly commentary. We've experienced a 2-month correction in the market, and the market hasn't offered very many clear signs of what direction it's going to go in the future. The economic indicators consistently suggest the possibility of a recession. Yet, the stock market has been on an upward trajectory throughout the entire year just based upon a handful of stocks. Our task today and going into the end of the year is to assess whether the recent decline over the last couple of months is a more significant downturn, which I personally believe it is, than it is an opportunity to capitalize on the dip. Let's dive into it. So jumping into our commentary for this month. First of all, there's been a lot of volatility in the market. A lot of this is driven from the Fed. So this month, the Fed has a higher for longer approach. Doesn't mean they're raising anymore, but what it does mean is that you're going to see these rates kind of hang around longer until I believe that the Fed breaks something, and it's probably going to be the banking sector. So inflation is still persistent. Remember that we're trying to hit 2% on the inflation rate. Right now, I think it's at 3.7. So unless we get to that number or a recession happens, the Fed's going to stay put. There's a lot of strikes in the auto industry and some slowdowns in every industry that we're seeing. So stagflation is now on the table. There is market risk, and it is clear. Therefore, our strategies are about to adjust to reduce risk. There's a lot of good information on our metals and our long-term treasuries to help reduce risk in the overall portfolio. Also, let's dive into it and take a look at our first slide. So the Fed is understanding the data is getting worse for the overall broad market. So they've already paused any more rate hikes, but they reserve the right to actually re-raise again sometime in the future. I don't think that's going to happen though. So we have about a 69% chance that they're going to pause for November and December. The probabilities are starting to raise that we're probably done with rate hikes here. However, inflation remains high from the energy prices. That is going to be prominent through the entire markets as we're entering two wars. Both of those have oil energy as a concern. The NASDAQ is down 10% from its August highs. May see a rebound here in November, but I think that's going to be short-lived, and that's what our models are showing us today. The aggregate bond market benchmarks are down 5% year to date as of October 25th as well. And so we're seeing as the Fed keeps on pouring on bonds inside the market, the market has to digest that by raising bond rates. I don't think that's going to be lived very long. I think there's going to be a flight to bonds, and it's going to drive down the yields over the next couple months to maybe 6 months. We're seeing that in the data as well as the inversion of the 2 to 10 is starting to correct. More on that later. So let's jump into inflation elevated and recession is more likely. Core inflation is up 3.7%, again, above the 2% target that the Fed wants. The Fed remains hawkish, but rates are much greater than inflation. So we'll see where that ends up. I think they're going to pause and let the market kind of clear its throat, and I think the recession's right here anyways. So October 1st, the market returns for the student loan payments. This is going to put a lot more pressure on the middle and lower class to be able to weather not only inflation, but now they have new payments coming up on it. So food and home prices are up 5% year over year, but bacon is down 9%. Everybody loves bacon. I mean, it's almost 10. There's nothing bad about that one. We should go down a little bit more though. And if you're thinking about buying orange juice, think again, as orange juice itself is up over 300%. I have no idea how that happened, but that is something that's very concerning there. All right, so the ongoing workers' strike has potentially contributed to a future inflation. So the UAW, you've probably seen this, strikes asking for a lot as the UPS is up. Employees ask for $175,000 salary. This is nuts. This is absolutely crazy. The average American income in the United States is roughly around $55,000. They're wanting more than 3 times, or right at 3 times, the average American salary. I don't see how that's going to happen, and it's going to continue to put pressure on raising auto prices in order to offset the current cost to manufacture. There either needs to be an increase in labor cost for the product or a reduction supply to the slowdown in the production. This issue could be worse when people start falling behind on their credit card debt payments. The experience is a decrease in income. These factors combined with a negative cycle in the retail sector, which may eventually impact the financial sector as well. Businesses could suffer financial losses to reducing consumer demand. This might resort to layoffs of employees, and that would turn into a full-on recession, which we have baked into our models for the end of this year going into next year. This in turn could result in higher unemployment and a raise in loan defaults, creating a ripple effect that cycles back to every single business in America. As an additional result, banks holding both business debt and real estate assets could be at risk at potentially leading to bank failures. Last, deposits at these banks may decrease, and the need to liquidate real estate assets may become necessary in order to survive this credit crisis. This is the meat of our market commentary for this month. The market is undoubtedly at risk right now. We've witnessed already several 10% declines in recent months. If you take a look real quick, the overall pullback that we've had from August's highs, it's actually late July, and we've seen, this is on the S&P, we've seen almost a 10% or a little over a 10% decline. We're going to see a soft rebound is what we're projecting over the next month or so, and then see a very large recession going into the end of the year. All of this is subjective. We look at many metrics to see how the probabilities stack up against this, and these charts are looking very, very high probability of continuing this wave 2 up for just a little bit of time around that 4380 level on the S&P, and then a substantial pullback all the way down to 3800. The current situation is somewhat distinct in that there's very factors indicating potentials for a recession. However, this is worth noting that similar scenarios existed as early as 2007. I personally also believe in 1987 there's correlation here, but yet the markets rebounded very nicely from the lows of 2007 of about 15% before the actual recession hit us. We can never predict the future. And as we look through some of these charts, we always try to understand probabilities inside of our charting. And technical analysis is never perfect. We always love buying into highly probable fundamentals of companies and holding those for long periods of time. Our technical analysis that we put inside of our portfolio is for short term to mitigate risk and downside, which we've seen significantly over the last couple of years. So this takes us to the individual sectors that we're reviewing right now. The market breadth has experienced a significant downturn, indicating a potential further decline, encompassing everything from small cap stocks to utilities. You can see the significant decline right here is being outpaced pretty dramatically on utilities and also small caps. However, the overall broad market has still experienced over a 10-11% decline. This has just been rapidly decreasing. I would like to note though, take a look at what happened earlier in the year, January, February, as the flight to safety has been into the value sector more than it was over the overall S&P. I believe we're going to witness this again as soon as we get this market pullback, if that does end up happening. I think value is going to outpace growth. However, the challenges has been to pinpoint when exactly the markets will hit bottom. These uncertainties extend to the bond market as well, and it's really hard to see where yields are and how everything moves. Before we move slides, remember this downturn has baked in value for us to buy these utilities sectors, this consumer staple sectors, the healthcare sectors. We're buying these securities and holding them in our portfolios as almost a hedge because there's not a whole lot negative or pullback it can go. There's only so much a limit until the valuations of these companies become unrealistically cheap. And I think we're in that market right now. The bond market is there as well. So let's switch over to the bond markets. So if we're looking at the 2-year and the 10-year, it inverted all the way down negative almost 1.2% at its low. And this is back in July. That inversion now is starting to lessen, and it's almost all the way back to 0.175. So we're fixing to be uninverted, meaning the natural flow of the bond market's fixing to be restored. However, that means typically we could see the actual recession closer and closer here, which is what I personally believe. So that's it for us. So I hope you really get some value out of this. It takes a lot of time for us to put these things together, and I know we've missed a couple. We've been really focused on a couple things inside of the market and overall planning with our clients. As we roll into fourth quarter, it is becoming tax planning. So if you'd like to have a tax planning strategy with us, please let us know. Here's some special news for you. We came out with our new magazine. It's called Pursuing Alpha. It goes right along with our podcast, which is also Pursuing Alpha. So if you hadn't heard our podcast or didn't get a copy of the Pursuing Alpha magazine, it comes out twice a year, so you won't get another one until around April of next year. If you would like a copy of our magazine and actually understand a little bit about some of the other guys on our team and how they think, there's some really good articles in there. Let me know if you didn't get a copy. I'd love to send you one. Talk to you all soon. Have a good month.